they try to conflate inflation with prices. So when they say inflation is going down, they're trying to get you to think prices are going down, but they're not going down. Right? Prices are going up but at a slower pace. And like I said, the powers that be will not allow price inflation to actually go negative, i.e. they won't allow prices to fall. Because if prices fall, then their whole economic model of spending equals growth falls apart. And the economy contracts, and that's not good for the US on the global stage. What happens? What's the solution? The solution time and time again is to stimulate, is to print money, is to create new emergency lending facilities, is to, in one way or another, however complicated us monetary plumbers want to make it, create new money where there wasn't money before. But ultimately, if the solution is to print and print and print and devalue and devalue and devalue, then Bitcoin, serving as the foremost leader in being a porous sponge for that global liquidity, will continue to grow and grow and grow and grow.
Before we get into the episode, Blockware is giving away a free Antminer S19 XP and 1 year of free hosting. This deal is worth over $7,000. To enter for a chance to win, all you have to do is sign up for the Blockware Marketplace, complete the 2 onboarding steps, and head to our Twitter account, @BlockwareTeam, and like and retweet our pinned tweet. For more information, click the link in the description. Now, enjoy the episode. Hello everyone, welcome back to the Blockware Podcast. This week we've got on Joe Consorti, analyst at the Bitcoin layer. Joe, welcome.
Thanks a lot for having me, man. I'm wicked excited to chat with you today.
Likewise, when I found out I was gonna be taking over the pod, you were the first person I reached out to. I just knew I had to pick your brain on some stuff. And before we get into a lot of the juicy macro things, which will probably be the bulk of this conversation, I want to talk a little bit about college. So you did like a 30-minute long video the other week talking about universities and the student loan situation. And since we both got out of school within the last year or two, we're pretty much fresh out of it, right? We saw how like messed up everything was in the post-COVID university world. So could you talk a little bit about your experience from an educational standpoint, and then compare that with what you do now at the Bitcoin layer, you know, sort of self-teaching yourself online and working very closely with Nick Bhatia?
For sure, yeah. So I mean, with school, I got a lot out of it personally, but also my experience was truncated because of COVID, right? I went in initially, I wanted to be a doctor. That didn't, I ended up switching into finance and economics pretty shortly into it because in high school I was really involved in a business club. I was the president of a couple parts of that club. And then, I went to college to become a doctor because I knew that that's what paid the most. But then I realized if I have all these skills, may as well run with them. I had a huge interest in markets. And so I started researching markets independently. They had Bloomberg terminals up there for free in the library, so I really leveraged those pretty heavily. And then I got an econ degree. And it wasn't until I started, scrolling Twitter that I began to understand that a lot of what was taught in my econ classes was a whole load of horseshit, frankly. The Keynesian economics mindset, the modern monetary theory that we're taught to get these econ degrees, a lot of it revolves around this idea that economic growth and prosperity should only hinge on spending. Spending is like this the main barometer for economic health and success. And because of that, there needs to be a central authority that can manipulate the price of money up and down in order to stimulate or suppress aggregate supply and aggregate demand, which are these big abstract concepts and ideas that one central authority can coordinate the price of money for several million different capital allocators across the world that participate in US dollar capital markets. And only when you explain that, only when you say those first few sentences, does the absurdity really hit you that one entity could accurately set the price of money and allow the economy to go around, and that we could stimulate and suppress the economic growth by raising and lowering this central price of money that works, with several month lags. And so it was only when I started using Twitter really frequently to start publishing a lot of my research and reading from other people that I began to understand these concepts and really get introduced to the Austrian school more. And from there, doing research, reading books on my own, that sort of became the primary way with which I went about my economics education. Of course, I was taking these classes, and some of them, a lot of the material that I gained there, very invaluable, but the core tenets. The core tenets of modern monetary theory is the propaganda stuff that you really you need to develop an adversarial mindset towards. And when you're in school, you just don't learn to do that. And so Twitter helped me out with a great deal of that. Now as for working with Nick, that's also been a huge help. He's a great mentor. Frankly, obviously, he's been involved in markets for a decade plus. He's a writer. He is very immersed in the economy. So tidying up a lot of my framework, Nick has certainly helped quite a bit there. But I would say that there is a decent amount of utility in a college degree, in a college education, but it's diminishing over time, right? We live in the era of information. Information is free and abundant. You have a supercomputer in your pocket. Some people use it to consume, videos mindlessly and go on Netflix, and other people can use it to consume things that will allow them to produce more, i.e. learning materials, education, right? You can, particularly with Twitter, you can curate exactly what you want to learn. You can curate a world-class education. It's just down to the individual to be able to curate it and then take it all in. And then it becomes a matter of patience, which, again, is another thing we're sorely lacking. So, university was great. I found utility in it, but paired with, again, the power of the internet, the power of information, really nothing can beat it.
Yeah, I had a similar experience. Definitely a lot of what I know about Bitcoin and markets is thanks to Twitter. And it's just such an interesting juxtaposition there when you think about technology in general, right? It can be like the biggest hindrance to someone's success, right? If they're just constantly on TikTok watching nothing videos, or like you and I use Twitter to break through into the Bitcoin space, right? And educate ourselves and learn how markets really work. So such an interesting sort of juxtaposition there. On this idea of college and education, can you talk about this student loan crisis, quote unquote? Is it going to actually be a large problem? How will this affect the consumer? And will this have any effect on asset prices?
For sure, absolutely. So the student loan situation is interesting. It certainly is. Obviously, the first of this month, interest began accruing on federal student loans. Now, mind you, over 90%, I believe actually 95% of borrowers in the United States borrow federally, so they don't borrow private. I borrow private student loans, so I have had the blessing of paying those off and having interest accrue for months now, which is good because ultimately I want to pay for the loans that I took out of my own volition, like anybody should. But federal student loans were put on pause, and now they are resuming. And with 95% of student loan borrowers borrowing federally, that's not good. Of course, interest began accruing. Interest accrual was paused back in 2020. It is now resumed as of September 1st, and payments will resume in a few short weeks here on October 1st, less than 2 weeks from today. So for student loan borrowers, we got to think about, consumption and consumption habits. Obviously, let's just do a thought experiment here. If you didn't have to pay for one of your largest monthly expenses for over 2 years, there would be a structural shift in your spending habits, right? You don't have to pay for you don't have to allocate $800, $900, maybe even over $1,000 toward your student loans. Now that's $900 richer, of course, even though you aren't. Most people don't look forward and say, this is great. I'm going to leverage this time to build up this nest egg, build up my savings, and wait until they resume. Because remember, a lot of students thought that they would never have to pay these back. The reason this guy, our current president, Joe Biden, was voted in was because student loan borrowers, not me, they thought that they wouldn't have to pay these loans back at all. They thought that they would be forgiven, is the word that was used. Of course, that didn't happen. Of course, that's a silly, awful, moral hazard way of viewing the world and viewing debt, right? Ultimately, if you take on a debt obligation, you should have the means to pay it down. And before taking on a debt obligation, that should be your sole focus. Do I need to take on this debt? Will I be able to allocate my capital when I take on this debt in order to develop the means to pay it down? That isn't a thought that happens in the heads of Americans anymore. It's, college has become a next step after high school rather than higher education that was deliberately sought out by people who were going into very choice select career paths. Now it became the next step. As a result of that, all of these borrowers who have no hope of paying off their student loans took on $10, $20, $30, $40, $50,000 worth of student loan debt over 4 years, and now interest is accruing on that again. And on top of that, they've been able to spend for the last 3 years like this was never going to be an issue for them. So now consumption and spending habits are working in the other direction. Student loan payoffs hit an all-time high on August 31st, just before September 1st, and they continue to hit highs week after week after week. People are basically sprinting to pay off their loans as interest starts occurring again before the October 1st payment resumption. Now, of course, what does this mean for the economy? Well, just like we talked about at the start of this, the way that the U.S. measures economic growth, GDP, factors has spending, consumer spending, consumption as a huge component of our economic growth models. And so when we're gauging expansion, recession, a lot of it hinges on whether or not consumers are spending, whether credit is being expanded. And right now, with consumption habits falling through the floor, as people now have this $900 to $1,000 monthly payment that they have to pay every single month that they haven't had to for the last 3 years, that drives down consumption, that drives down expenditures elsewhere. And so when consumer spending falls, and this is not something like we've ever seen before. It's difficult to articulate like the magnitude of the way consumer spending is going to fall in the wake of this. But think about it this way, right? If consumer price index, if that is consumer prices, right? And all of a sudden, consumers are now reducing their spending by 20, 30, 40, 50%. Over 65% of individuals who have student loan payments due said that they would cut back on groceries in order to pay student loans. Several said that they would miss rent payments in order to pay student loans. Some said they wouldn't buy groceries and they would go on food stamps to buy student loans. This is a massive problem. Again, 65% said that they would cut back on grocery purchases to afford their student loans. So if you think about it that way, if the consumer price index is composed of prices of consumer goods and the consumers are saying that they're going to reduce their spending, what does that mean? That means deflation risk, okay? The Fed is already teetering on inflation, disinflation. We've had swift disinflation. Of course, the last 2 months have been a little bit bumpier, but the secular path is still down. Now, ultimately, what's going to happen here is that the deflation risk is going to be exacerbated, the risk that prices go down. Why is it a bad thing for the economy? Again, it all hinges on consumer spending. Our economic growth models hinge on consumer spending, this awful, stupid modern monetary theory way of looking at the world that we're just cogs in a machine that are meant to spend. And as consumers back away from spending, prices plummet, we risk deflation, we risk economic recession, right? Now the Fed, what does the Fed do? The Fed hates deflation for that very reason. Again, this silly modern monetary theory way of looking at the world is that if prices go down, people won't spend. I'm not joking. This is the way that modern monetary theorists in the Keynesian school looks at the world. They think that if prices go down, then people won't spend. And Dylan LeClaire had a funny way of putting this. He said, I just talked to a single mother of 3, and she said that she wouldn't be buying food to feed her kids because prices are going down. Right? If you put it into scenarios, if you put the notion that people won't buy things because prices are going down into a sentence, into an example, you can really start to stomach the silliness of it all. But that's the way that the world works. The Fed doesn't want prices to go down because inflation expectations are important. If people expect prices to go down, they're not going to spend according to their models. And so they'll stimulate. They want that inflation. That's why we have inflation targeting. Your money to be worth 2% less every single year in perpetuity. That's the idea. That's what economic growth hinges on, because economic growth is hinged on spending. And so with the student loan payment resumption, huge fall in consumer spending, deflation risk on the horizon, and of course exacerbates the already very large and surmounting recession risk that we have here in the US.
That was a fantastic breakdown. And you mentioned something, you tweeted it. Let me get the exact quote here. And it's talking about the same idea. Price inflation is falling, not prices. Inflation is falling. It's a misnomer, intentionally misleading semantic gameplay by politicians so normal people think prices are going down. And I think this idea of disinflation versus deflation is very interesting, right? Because when you have disinflation, prices are still going up. It's still getting harder for the average person to buy goods and services. So in my mind, when the Fed is having this battle versus inflation, I wouldn't think that they've won, quote unquote, until prices go down, right? Prices going up at a slower rate, it's still getting more expensive. In my mind, that's not a victory. But like you alluded to, deflation is very bad. They need to avoid that. So it's such an interesting concept there.
Of course, yeah. It's a semantic game that politicians play over the last 50, 60, 70 years to conflate price inflation with prices, right? Of course, inflation is the rate of change of prices, right? And prices are prices, okay? So think about it like a derivative, right? Prices are here, and inflation is the first derivative of prices. So basically, what these politicians have been selling you is that price inflation is falling. So prices are this, price inflation is this, okay? If price inflation is falling, right, that doesn't mean price inflation is going like this into the negative territory. That just means price inflation is going like this, right? And if price inflation is going like this, that just means prices are like this, right? Nothing has happened. They're still moving higher because ultimately, until this, the first derivative of prices, price inflation, dips negative, prices are still rising. All that price inflation is falling means is that prices go from this to this. They're just going up at a slower pace, okay? But this is the game that politicians play in order to get votes, and it's the game that the Federal Reserve plays. But it's primarily politicians, okay? Whether it's Republicans or whether it's Democrats. Right now, it's Democrats who are working in the halls of power. The president, as we see, basically the whole game is to mislead people. It's for the financially illiterate, for the layman, for the person that isn't involved in markets. If you tell a school teacher, right, someone that doesn't teach, economics. If you tell a school teacher or a fireman or a police officer or a carpenter or a welder that inflation is falling, right, they'll go, oh, great, because what does that sound like? That sounds like prices are falling. Over every financial media, every regular media, NPR, CNBC, every radio station you turn on, when you think inflation, they mean price inflation, right? They try to conflate inflation with prices. So when they say inflation is going down, they're trying to get you to think prices are going down, but they're not going down. Right? Prices are going up at a slower pace. And like I said, the powers that be will not allow price inflation to actually go negative, i.e., they won't allow prices to fall. Because if prices fall, then their whole economic model of spending equals growth falls apart. And the economy contracts, and that's not good for the US on the global stage. So the name of the game is perpetual monetary debasement. Trick the public into saying inflation is falling, but prices are never falling. Ultimately, this is a very, very bad game. This is a malicious game that's happened over the course of the last several decades. They want you to think, when they say inflation, they want you to think prices. They're two separate things. So when you hear inflation is falling, prices are not falling, okay? Prices are not falling. As long as there is inflation, prices are rising.
Yeah. And I think for better or worse, inflation has gotten so bad with the compounding nature of it. Even when they do these semantic games, 3% this year on top of 7-8% last year, it's such a noticeable difference now that people aren't falling for it as much because they can literally see it when they go to the gas station, when they go to the grocery store, that prices are still much higher than they were 3 or 4 years ago. And speaking of gasoline, and correct me if I'm wrong, this is why the last 2 CPI prints have gone up, is because energy is that portion of the basket is, there's not as much deflation there. Can you talk about that a little bit and this factor that's sort of beyond the Fed's control?
Yeah, for sure. So when it comes to the components of the CPI basket, CPI is falling, right? CPI inflation is falling. CPI will never fall, right? Okay, that's the aggregate price level. We just talked about that. But CPI inflation has risen for the last 2 months. It came in, it upticked a little bit last month, and it came in at 3.7% this month. Now, you got to understand a lot of this is driven by energy prices, which, of course, the Fed doesn't have much control over it. With the Fed, when they change the cost of capital, when they raise or lower interest rates, it has a several month lag, but what it has the effect of doing, ultimately, it draws money out of banks and into higher yielding assets. And so banks have less deposits, they extend less credit. Okay. Banks extend less credit. It's more difficult for people to finance their credit cards, to finance their living. So they bring down their spending, which brings down price inflation. Prices still go up because people still buy things, but prices go up at a slower rate. That's the multi-month, what happens when the Fed raises rates, and then ultimately, what is the conclusion several months later, 18 months later. So we've seen that part, right? It reduces consumer spending, but the parts of the basket that the Fed has very little control over because it's used everywhere and it is much more beholden. It is far less beholden to consumer credit and people just halting spending on it than anything else. It's fuel, it's energy, right? People need to heat their homes. They need to have their lights on. They need to cook for themselves. They need to drive their car to work, okay? So it's much harder to bring down energy prices than it is to bring down things like goods prices and services prices, right? Food. Ultimately, people can stop going to fast food places. People can stop buying as much junk food at the grocery store. They can stop getting their nails done and getting their car washed. And this brings services and goods prices down. But as for energy, that is the component that the Fed has very little, if not the least, control over. And so right now, what's happening is crude oil, the price is rising. It's been rising over the last couple of months. Now, whatever the reason for that is, it's anybody's guess. Ultimately, there's several factors at play, right? We've seen OPEC and OPEC Plus and Saudi Arabia and Russia all cut crude production over the last year and a half. And that has had the effect of now the crude oil price is rising. That's certainly one effect there, but the energy component is what the Fed doesn't have control over, and energy price inflation is rising. So all other parts of the basket, goods, services, everything else, those are falling. Energy inflation is rising. So that's why inflation is kicking back up right now. Ultimately, hopefully the Fed looks at this and understands that their job in bringing down consumer spending has been accomplished. Ultimately, what's happening now is separate from what the Fed's policy tools will impact. The Fed's policy tools have very little effect on energy inflation. So if they take a look at this hot inflation print and they say, we got to hike again, that's bad news because the consumer is already entering into shambles. Okay, the consumer is already reducing their spending. The Fed's job thus far has worked. The parts of the CPI basket now that are inflating again, the Fed can't do anything about. And so the Fed reaction function should be looking at this, understanding its energy, and understanding they can do very little about it and not hiking further. But if the Fed decides to do the wrong reaction function, which would be to hike again, right, bad things could be on the horizon. It could worsen the outlook for the consumer worse than it already is.
Yeah, and the word I've heard so far is that the meeting this Wednesday, it's like a 99% chance they hike again. So probably not going to end well. You've stated what you think the Fed should do.
For this Wednesday, it's
Yeah, go
actually
ahead.
closer to a 0% chance, but for the next meeting, it's closer to like a
Gotcha.
30% chance. But all signs are pointing to one more hike by December at the very least.
Okay, understood. Yeah. And I want to get your take on this. There was a spike in yields last night, and the word is that it was like a data malfunction, which I tend to lead towards not believing that. Can you explain what happened in this situation?
Yeah, it was just a data malfunction. Ultimately, there's this guy on Twitter, Michael Gayad, who loves to be doom and gloom and sensationalist and stuff like that. But no, nothing happened yesterday. Basically, what happened was overnight, the 2-year yield spiked up to 5.3%. Up from where it closed on Friday, which was closer to 5%. Okay, so a 25 basis point move as soon as markets open on a Sunday night. That's really bad. But then you realize, wait a minute, no markets are trading on Sunday night. Okay, so this was just a glitch. Ultimately, bad data providers didn't factor in the fact that Japan is closed. And so something happened and yields spiked. That wasn't actual pricing or trading data for twos because twos were not trading. Japan was closed. No trading was happening on Sunday evening. We're recording this on Monday. So that's what caused the yield spike on actual high quality data providers, not bashing trading viewer CNBC, but things like Bloomberg, the Bloomberg terminal. I took a look. Nothing happened intraday. So just a weird spike that happened with other data providers. But you'll be certain I'll be the first one to cover it should something like that actually happen, because I've been sounding the alarm about, Michael Guy had a bit of a shill. He blocked me. I don't care. He blocks everybody. He's a loser. Anyway, he's a sensationalist guy. He doesn't make probabilistic calls based on data. He just types few, period, and then sends it off, and then all of his followers gobble it up and go, yes, 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 right? But whatever. I'll be the first one that actually covers, I'll be one of the first people that covers if there is a huge sell-off in treasuries, which I don't feel there will be, because obviously we are the asset that people pour into globally in times of need, because I've been sounding the alarm about this for ages, right? With the huge issuance schedule, that's going to push yields very, very high. And if this big sell-off occurs for whatever reason and yields spike and somehow the Fed needs to intervene, then what happens then? And there's some kind of Fed intervention, I'll be the first one to cover it. But of course, the Fed, given the fact that we're the global monetary leader, we have this huge entrenched demand for treasuries, even as there's this huge influx of them. This year is record inflows over the last several decades for treasury inflows. And also the Fed set up BTFP, which makes it so that banks don't have to sell their treasuries, which basically negates any other sell pressure that would push yields higher. I don't see a spike like that happening for U.S. treasuries. Ceteris paribus, huge black swan event. We'll see, but certainly not right now, and certainly not on a Sunday evening. But we have seen strange things happen on Sunday evenings, but this one was just a glitch.
Yeah. Do you expect, like, sort of looking forward, and I guess this is sort of speculating, do you think the demand for U.S. Treasuries will always be super high? I mean, with the whole Russia thing and like they're getting cut off and not from their treasuries or whatever, and the fact that the Fed is going to have to issue so many more at a higher interest rate going forward just to pay off the existing debt. I mean, the way I look at it, there's going to be so much supply. They're going to have to issue so much debt. And you're more versed in macro than me. So can you talk about how, that's not going to be a doomsday scenario, or maybe it will be?
For sure, yeah. So for me, I look at things like de-dollarization and BRICS, and I don't take them super duper seriously. Of course, I'm still a student of the game. I'm still 22 years old, very young. But I look to people far more intelligent than I. People like Nick Bhatia, my mentor. People like, Brent Johnson, people like Andy Constant. And over the last year and a half, 2 years, I have come to understand that U.S. Treasuries are a globally entrenched market. What I mean by that is U.S. Treasuries are used as collateral for lending everywhere, and they are the world's preferred collateral. That's what we mean when we say world reserve currency. Everybody holds U.S. Treasuries because in order to engage either in a cross-border or a transaction within your country, chances are U.S. dollars are going to be one side of that trade serving as collateral and also serving as reserves. If you have U.S. dollars, there's no other market to put them in other than U.S. Treasuries, right? If you're a huge nation like China, like India, like Brazil, where are you going to store all those U.S. dollars that you need to engage in global trade? You're just going to hold them in cash and have them depreciate? No, you're going to buy assets, yielding assets to offset some of that depreciation. And the only liquid enough market to allow for all of that liquidity to come in and have a place for money, for capital to park in the meantime, is U.S. Treasuries. And so countries that have these foreign exchange reserves, they put all of them, and the lion's share of them, at least the ones that they need liquid and readily available to convert to cash and engage in trade, they put them in U.S. Treasuries. So there's that demand. Then there's also the fact that globally, U.S. Treasuries also serve as collateral for a great deal of lending, whether you're a small business, big business, or operating cross-country, cross-continent. U.S. Treasuries often serve as the collateral for any type of loan because they're so large, because they're so deep and so liquid. And so during Bretton Woods, we really lucked out. And we lucked out because at the time, right, post-World War II, the global economy, certainly globalization was beginning, but the lion's share of it hadn't begun yet. We lucked out at Bretton Woods because before the grand global expansion of the next 80 years, 79 years, took place, the U.S. dollar was decided that it would be at the center of it. So think about it this way. The global economy is this huge skyscraper, biggest skyscraper in the world that's been built over the last 80 some odd years. And the US dollar is the concrete that makes up the foundation of it, way below the building. So you have hundreds of floors, taller than the Burj Khalifa. That's the global economy. And over the last 80 years, the dollar is the concrete underneath it. Like I said, countries, businesses, they use it not only as collateral, but as a place to park all of their reserves that they're going to engage with in trade. 25, 26, $27 trillion. The value of it goes up by the day. Okay, the largest single market for a single asset in the world. Now, you have this complex web of relationships that all rely on this US dollar and US Treasury foundation, right? They're both dollars. They're both considered cash. Now, how are you going to displace that? You have this complex web of relationships. You have this several hundred-story building built atop the US dollar with all these complex relationships. Those are, I guess, the struts and the beams that make up the building and the windows and the office space inside that supports the office space inside. There's no way you can replace all that concrete underneath the building, right? At least not without destroying the building or destroying a great deal of the building or risking destroying the building, okay? And ultimately, if the concrete is working, if the concrete is doing its job and you want to replace it with any other kind of material that would be just as good as concrete. If the concrete is doing its job and it has all the same strengths and weaknesses as any other kind of material that you could replace it with, why replace it? right? If the building has to come down in order to replace the concrete, why replace the concrete? And so that's ultimately the role of the US dollar and the role of US treasuries in the global financial system, and ultimately the dilemma about why it's never going to go away for the next several decades at the very least. And people will say, well, that's complacent, that's silly, blah, blah. But the data is backing up what I'm saying. The more sensationalist side of the coin would be, the dollar is going to be replaced by a coalition of nations that are going to come together and determine to use a new currency. But exactly what I said just stands. All of these other currencies are facing the same strengths and the same weaknesses as the US dollar, but none of them are as widely used as the US dollar. And so unless there is a currency that is facing less depreciation, there isn't. A currency that is used more widely, there isn't. Then no currency is going to displace the US dollar. Think about it this way too. If a bunch of nations came together and said, well, let's start using this the Argentine peso or the Brazilian real. Let's start using the Brazilian real. Okay, we all start trading in Brazilian real, these 5 countries. Now I'm China. I have a bunch of Brazilian real. How am I going to trade with Canada? How am I going to trade with Greenland, right? Or Switzerland or France or England or Italy? They don't have a lot of Brazilian real. Uh-oh. So from a global balance of payments perspective, it also incentivizes the players to keep using dollars. Again, this complex web of trade relationships and business structures that rely on US dollars and US treasuries, that just you can't unplug it and plug it back in. It's a lot more difficult than that. It's multifaceted. It's well beyond the scope of what anybody can understand. And so people that are very reductionist in it on either side of the coin are really fighting a losing battle. But I think all signs point to, given the data, given the point and purpose that U.S. Treasuries serve, that the U.S. dollar as the world's most liquid currency and the U.S. Treasury market as the world's most liquid asset, that's here to stay. That's here to stay for the next several decades at the very least, unless for whatever reason the United States crumbles as the world superpower, bringing the global economy down with it, bringing that skyscraper down with it, and the foundation has to be replaced and we all start anew. Right? That's genuinely the only scenario I envision that would allow for another currency to displace the dollar. It's just the role it serves in the reality of the situation.
That was a lot to unpack there, and you laid it out, and that was very good. So where someone who's hearing you say that all that, and they're not familiar with you or your work, they're going to wonder, you sort of sound like a fiat maxi almost there. So where does Bitcoin fit in your thesis in this framework? This analogy you've used of this building, I like that. Would Bitcoin just be like a separate building that's getting built up, and it's like, hey, let's leave this fiat building with a shaky-ish foundation and go over to Bitcoin? So how do you view Bitcoin in the grand scheme of the macro landscape? Taking Bitcoin off the exchange and putting it into self-custody is a big responsibility. And if you're going to do that, which you should, you need to make sure your seed phrase is secure. Simply writing it down on a piece of paper is not the best way to go about it. All sorts of things can go wrong when you do that. You're going to want to stamp it into metal. Using one of Stampseed's metal plates, you can ensure that your seed phrase is immune to fire damage, water damage, and just general erosion that happens over time. Head to Stampseed.com and use the code Blockware15 for 15% off at checkout, and you'll sleep much sounder at night knowing that your Bitcoin seed phrase is stamped securely into a metal plate.
Right. So Bitcoin, as it's traded, is a high beta risk asset that absorbs global liquidity as global monetary expansion and contraction ensues over the course of cycle after cycle, right? That's how it's traded. But the reality of the situation, like I said, is it's this porous sponge for global liquidity. At the start of this conversation, we talked about how silly it was for modern economists, the modern monetary theory pundits, the Keynesians of the world, to say that there's one central authority that can manipulate the price of money up and down and that will stimulate and contract the global economy. Every single time, every single cycle, that ends in a boom and it ends in a bust. Okay, this huge blow-off top, expansion in economic activity. People who are once impoverished now own mansions. This is exceptional. Everybody's earning a great deal of money. Inflation is relatively under control. And then it ends on the other extreme of the spectrum when it all comes crashing down. The cost of capital comes back to reality, i.e. not zero. And then all of a sudden, all these distortions that have been created during the boom, they come to a calamitous bust. Everybody's out on the street, right? And then what happens? What's the solution? The solution time and time again is to stimulate, is to print money, is to create new emergency lending facilities, is to, in one way or another, however complicated us monetary plumbers want to make it, create new money where there wasn't money before. Now, that is a solution cycle after cycle. Austerity isn't the solution. Austerity is never the solution, right? Maintaining a normal cost of capital, or even doing away with a centrally planned interest rate and allowing interest rates to proliferate on their own, that is never the solution. Austerity and monetary reality are never the solution. The solution is always to close our eyes, stimulate again, and create another boom. And then, of course, it inevitably follows with another bust when we have to bring the cost of capital back to reality. The solution for all of this would be to bring the price of money to a level that reflects the price of money. And the only way to do that would be to do away with a central monetary authority that sets the price of money, right? Allow interest rates to come back to reality. Allow them to come back to being calculated based off of the creditworthiness of the borrower and the supply and demand for credit. That would fix these distortions and do away with the boom and bust cycle, but we'd be sacrificing our economic growth. Remember, economic growth all revolves around spending, spending, spending. And so with having a central authority at the helm that can stimulate and create spending out of thin air, that's not a role that the government's going to give up. And if that's the case, the solution after every economic bust will be stimulate in one form or another, create new money where there wasn't money before. So if that's the case, it's going to be the case for all global fiat currencies, because ultimately on a world stage, if you want to be attractive, it's all about interest rate differentials. Are you offering a higher or lower interest rate than the competitor? And as the US, we have the ability to influence what other interest rates around the world do, what other countries do with their rates. If we're stimulating, chances are other people have to stimulate too. If we are contracting, if we are raising rates, other nations have to do it too. It's all about making your nation more attractive from an interest rate differential perspective. And so this is the end game for all government currencies, not just the US dollar. And so the US dollar is the king. It's going to stay the king, and it's going to underpin the global economy for several decades to come. Nothing of what I said 10 minutes ago when I talked about the US dollar hegemony not going away, none of that is contradicted by what I'm about to say here. But ultimately, if the solution is to print and print and print and devalue and devalue and devalue, then Bitcoin, serving as the foremost leader in being a porous sponge for that global liquidity, will continue to grow and grow and grow and grow. The reason it's the world's most porous sponge is because it's, of course, divisible to near infinity, divisible into 100 million individual units, and it has a maximum supply cap of to 20,999,999.9999, right? 21 million. So it has an absolutely fixed supply, absolute scarcity, which is something we've never known before. And it's divisible almost into, relatively into infinity. When we're talking about economic units in the US dollar system, the idea that something can be divisible into 100 million is a foreign concept. So that's why I say infinitely divisible. It isn't, but it's close to it. So it's absolutely scarce and almost infinitely divisible. That's insane, okay? And that's what makes Bitcoin the most porous sponge for global liquidity. There's no other asset that is absolutely scarce and as divisible as Bitcoin is. And so if you draw this all out to its natural conclusion, several years, several decades, and people don't want to think in decade time frames, we all have too much hubris, and we want to believe that Bitcoin is going to be this massive asset in our lifetimes. It may be, it may not. Ultimately, it may take several decades. It may be far shorter than I'm imagining, but again, what I'm imagining is two separate camps here. Okay, I'm imagining Bitcoin in this. I'm imagining global fiat currencies with the dollar very much at the helm. Right? People think Bitcoin and the dollar are competitors. That's a silly notion. The U.S. dollar at the helm of of all these global currencies, dominating the world economy and underpinning all of it. And cycle after cycle, the solution from central bankers is not austerity, but is to create more money, which devalues this whole global bucket of currencies. When the US devalues, everybody else has to, and vice versa. So cycle after cycle, this becomes worth less and less and less and less and less. And this global sponge, the most porous global sponge for liquidity, keeps expanding and expanding and expanding and expanding as more individuals decide, I'll allocate a little bit towards Bitcoin. I'll allocate a little bit towards this. I start to recognize the value proposition of this a little bit more. I start allocating to this. And ultimately, these two assets will continue to monetize in tandem. People will keep buying US dollars and US treasuries just as people will keep allocating to Bitcoin. And cycle after cycle, this big porous sponge of global liquidity will continue expanding as global liquidity keeps expanding as a response to every single bust. So that's how I view these two monetary technologies monetizing in tandem. Of course, Bitcoin is very infantile. The US dollar has been around for ages. The US dollar can and will reign king for several decades as Bitcoin monetizes, and it all comes down to central banks. What will central banks do? If you make a return to austerity, that's exceptional. The value proposition for Bitcoin in the West is gone now. But we know that that will never be the case. We know that central banks won't return to austerity because they won't allow a multi-year recession to take place because it will make their country less attractive on the world stage. That's why the solution is to always print, and that's why inevitably the outcome will be Bitcoin doing very well in the long run. At the very least, that's my thesis.
Very well put. One of the programs which they've used to do this sneaky injection of money is BTFP, and you've been hammering the BTFP charts since its inception. And something I've noticed recently on Bitcoin and finance Twitter in general is a lot of people just don't talk about the fact that we had all these bank failures go on earlier in the year. It seems to have been forgotten. Mm-hmm. So can you talk about, are these regional banks still under stress? And you've put a couple charts out sort of demonstrating that. So can you speak on this a little bit?
Yeah, so regional banks are still facing, they're still facing really acute stress, particularly because these regional banks, they have smaller capital bases than large banks. I said a little bit earlier, when rates rise, when the Fed raises interest rates, it has this effect through several steps of liquidity exiting banks and moving into higher yielding assets, primarily U.S. Treasuries. At the very least, exiting the deposits that are held at banks and entering the money market funds that are held at banks that banks can't extend credit from. Banks extend credit based on their asset base size, their securities, and their loans. And if they have fewer deposits on board, they cannot extend as many loans as they did. And so, ultimately, that makes these banks that don't have a lot of loans outstanding and they don't have a lot of assets, but their deposits are flamed, that makes them a lot more stressed and a lot more prone to collapse. So they're extending less loans because they have fewer deposits, but also their assets are devaluing to an extreme degree. And as a small bank, you just don't have the liquidity buffer to withstand those losses. And at some point, you either have to you have to downsize to the best of your ability, or you have to sell those assets and lock in those losses. And ultimately, a lot of regional banks, again, that have really small liquidity buffers and can't handle this devaluation stress and this stress of deposit flight, they go under. Now, the Bank Term Funding Program is essentially a Band-Aid for this. It's a Band-Aid for this problem of banks having to sell devalued securities and lock in losses. Basically, it's a loan facility that the Fed set up where banks can take their devalued U.S. Treasuries, take them to the Fed, and get par value. So if I have 50 cents, I go to this facility, I get $1, okay? It's a loan facility, has to be paid back, at least for now. And basically, that allows banks to wipe away these losses off their balance sheet, stave off any forced selling, and stave off bank failures. But the problem is that many regional banks do not meet the collateral requirements. Their asset base is not big enough, or they do not have the quantity of assets, specifically U.S. Treasuries and agency MBS, that are needed in order to go to the Bank Term Funding Program and secure these emergency loans. Same with the discount window. The discount window is a similar emergency loan facility. So for these smaller banks, they have very, very limited options. And basically, many of them have been forced to close their doors because, again, they got to sell. They have to sell their assets in order to meet these these withdrawal requests. They can't go to BTFP or the discount window because they don't meet their collateral requirements. And so that's why more regional banks are failing than larger banks. Regional banks do not have the collateral requirements to go to BTFP, get those emergency loans, so they become forced sellers in order to meet withdrawal requests, and then eventually they become insolvent. But another thing that's happening, it's happening kind of behind the scenes, not a lot of people have seen it, is the Bank Term Funding Program, the growth of it has actually stagnated. Same with the discount window. So fewer banks are actually getting more loans from the Fed's emergency facilities. That's because, just like I said, they're doing the other thing. They're selling securities instead of getting emergency loans from them. The Bank Term Funding Program has about $108 billion worth of emergency loans outstanding. And since March, when these banking failures happened, over $158 billion worth of securities, specifically U.S. Treasuries and agency MBS, have been sold by banks in order to meet ends meet. So banks are doing this in two different ways. The banks are making themselves whole in two different ways. They're either going to the Fed for emergency loan and selling assets. And like I said, it's tough to get an emergency loan if you're a small bank that doesn't meet the collateral requirements. And it's also tough to sell enough assets in order to meet all of your withdrawal requests. At some point, you go insolvent, and you go insolvent far sooner than larger banks with those smaller capital bases. So that's why the acute stress that regional banks are facing has not abated at all. It is still very much present. Bank Term Funding Program solves part of the solution, but if you were a very, very small bank, you were still at a very high degree of risk.
Interesting. I find it weird that there's a collateral requirement when like the collateral is U.S. Treasuries, right? So shouldn't the even the smaller regional banks, in theory, they should be able to use this program, right? Because the collateral they have is U.S. Treasuries. Granted, they're underwater and they're not going to mature for quite a while, but I would think that would be
Yeah.
enough in the mind of the Fed. But do you think there's like a collusion to just sort of funnel up all the smaller banks into like all the JP Morgans and Wells Fargos of the world?
Could be, could be. I wouldn't get that conspiratorial with it. I usually love to get conspiratorial, but with this, at least when I'm telling my followers things on Twitter, I try to keep it brass tacks and probabilistic. I'd love to be conspiratorial. The reality of the situation, though, is that is the effect. Whether it's intentional
Yeah.
or not, the effect is that regional banks fail. They get absorbed. Buyouts by the FDIC and buyouts by larger banks. These banks get absorbed by larger banks. It's all funneling to the top, right? We used to have 60, 70, 80 major banks in the early 1900s. Now we have four. So whether or not it's intentional, that's the effect.
Yeah, for sure. Another problem that you've talked about that specifically affects the regional banks is commercial real estate. And this sort of gets talked about a decent amount. And is it just like a false flag, nothing to be worried about? Or, what's the latest information with commercial real estate? And is there a timeline where this problem will really start to manifest?
Yeah. So it's a sticky situation. It's a hairy situation. There have been several statistics going around, and people have corrected me on Twitter for some of the statistics that I've posted. But broad strokes, 30,000 feet, the reality of the situation is that commercial real estate vacancies have never been higher, right? Conservatively, 20% in metro US office space, the highest it's ever been. That's conservatively. And in more concentrated downtown areas, it's reportedly closer to 50, even 60%. That's bad. If your cash flows are drying up and you have mortgage payments due, if you have loan payments due, that's bad for the lenders, right? Because they don't receive those loan payments. Of course, it's bad for the companies because they go under, they fire people, whatever. But it's bad for the lenders because they miss loan payments. They have to tighten up standards, which makes it harder for more people to sign leases on empty buildings. So it's not a pretty picture. And ultimately, I think creditors are going to take some pretty big losses. They already are. And as commercial real estate loans continue coming due and borrowers push out their maturity as far as they possibly can and they maturity default, which means they're not allowed to pay. They can't pay at the scheduled date of maturity. They have to extend that maturity and them and the lender work those terms out. Creditors are going to take some big losses here. We've seen over 50% of the commercial mortgage-backed securities that were due or loans that underpin commercial mortgage-backed securities. Over 50% that were due in August were faced maturity default. So people who owed that money couldn't pay it right then and there. They had to extend the terms with their lender. I'd imagine a lot of those maturity defaults will turn into actual defaults when that negotiated date comes to pass. So, I don't view it as imminent Armageddon scenario, but there's a structural shift paired with higher rate, structural shift in the way that we use downtown office space paired with these higher rates. That is going to be a huge problem for creditors. It already has been. They've been able to negotiate terms further into the future, but rates aren't coming down. People aren't returning to the office. So I have a feeling a lot of those maturity defaults, i.e. kicking the can down the road a little bit, those will turn into actual defaults, which will turn into losses to lenders. And of course, the lion's share of lenders for commercial real estate, who would have thought it's those same regional banks that are already having a very tough time and they'll have to take more losses, right? It's just the reality of the situation.
Gotcha. And a chart you tweeted recently is the reverse repo liquidity, and it's basically gone straight down since March of this year. Can you explain to someone who may not be familiar what the reverse repo crisis of 2019 was, and are we sort of headed to a similar situation? Because I know that resulted in a bunch of liquidity getting pumped in by the Fed. So can you talk about what's going on with the reverse repo market?
Yeah, so in 2019, there was a cash shortage in the repo market, and it temporarily caused overnight rates in LIBOR to which is one of the main overnight borrowing and lending rates for financial institutions to spike really, really high. And that was the cannon fodder to transition away from LIBOR to SOFR, which is a reference rate that is actually controlled by the Fed. So one of these rates that was not controlled by the Fed is now controlled by the Fed, the primary overnight rate that banks reference when they're writing and extending loans to one another to meet funding needs. Now that's in the Fed's court, but that's another story. But that's what happened there. And what it elicited was Powell moving away from raising interest rates. And he paused interest rate hikes right then and there and began cutting rates shortly after. And that was 6 months before COVID. That was September of 2019, 6-7 months before COVID. So, we are, right now basically what happened there was denoted throughout the years as the Powell pivot. This has kind of become what he's been infamous for. It's become something that kind of lives in infamy and what he's known for. And he doesn't want to do that. And now he's working in the exact opposite direction. So he pivoted at the first sign of weakness. Granted, a pretty big sign of weakness. You do not want rates in your overnight borrowing and lending market that banks use to meet their funding requirements to be as high as they were. If there's some kind of shortage there, that needs to be resolved. But it caused Powell to really second guess himself, second guess his hawkishness, and move into extreme dovishness. And of course, 3-4 years later, we've now seen an entirely different Jerome Powell, who's totally unfazed even at the most minor signs of weakness. He really wants to correct not just price inflation, of course, but also these guys are pretty egotistical. He wants to correct his legacy as well. Powell's a pretty old dude. He's 70-something. He's getting up there. He's a healthy-looking dude, but I don't imagine he has many more decades to live. And I think in the time that he is the Fed chairman, he wants his reputation to be not one of a dove that cowers away at the first sign of weakness, but to stay higher for longer till the job is done. That's the phrase that he's repeated, and he's trotted out the same statement time and time and time again. And the fact that he's repeated that statement basically at almost every meeting with very little changed language in his formal address indicates just how serious he is. So in 2019, what happened in the repo market caused the Powell pivot. Now, not only is Jerome Powell working to correct price inflation and fix the Fed's reputation, because the Fed's reputation is extremely important to its ability to influence monetary policy and influence where interest rates go, because they influence investor behavior by setting the policy rate. He's also working to fix his own reputation at the same time before he stops being Fed chairman and ultimately before he steps off this mortal coil. He does not want to be a softie. He wants to be a guy that got the job done, even if that means displacing millions of Americans from their jobs. It is what it is.
Yeah, I think, unfortunately for Jerome Powell, the money printer go burr memes have circulated far too often, and I think he could hike rates to 15-20%, and I don't think his legacy will change because those money printer go burr memes are just so hilarious. If you had to sum up in one sentence, or maybe not one sentence, but briefly summarize why you think a soft landing is effectively bullshit, because a lot of people think that the Fed may be able to achieve that, so why is that not the case?
Right. This is an interesting one, and I actually made a custom chart in Bloomberg onto the screen. It's called NT News Tracker. It's a cool screen, and basically what it allows you to do is it allows you to plot headlines over time. You can plot the frequency of a word or a phrase appearing in headlines over time. And I really like this because what I did, Michael Cantro tweeted something about this, and I discovered how to do it on Bloomberg, and I made my own chart. I plotted the amount of times that the amount of soft landing headlines, right? Soft landing basically means that the US economy was booming, and now we're going to bring it back to baseline growth without causing a recession. That's the idea of a soft landing. The amount of times that headline appeared versus the Fed's policy rate or Fed funds. And what you've seen through time over and over and over and over again is that headlines about a soft landing, which are always totally in vain, it's a pipe dream, they peak. They have this huge blow off top right when the Fed is done hiking interest rates. As soon as the Fed reaches its peak interest rates, soft landing headlines, they zoom through the atmosphere. Because the Fed, their interest rate, monetary policy, it works on an 18-month lag, 12 to 18-month lag until you actually feel the meat of those interest rate hikes begin to run their course. The meat of the economic contraction, credit contraction actually occur. And so there's this transient period, this temporary, fleeting period where the Fed has raised rates from 0 to 5.5%, but the economy is still fine, it's still stable. And that's when headlines about a soft landing, they spike. because everyone and their mother forgets about the long and variable lags with which the Fed's monetary policy tools take effect. It takes time. So the Fed reaches their peak rate, but there's this temporary period before economic calamity kicks in that everything's okay. And in that period, soft landing headlines spike through the atmosphere and they peak. But every single time, it's totally in vain. There's no such thing as a soft landing. A soft landing has never occurred. It's the idea that you can return inflation to a 2% target, maintain a 2% or 3% GDP growth annually, and you can do it all without unwinding the labor market. That's the idea of a soft landing. It's never happened, right? Ultimately, the labor market unwinds every single time at the end of every single Fed hiking cycle. It is always the end, like poetry, over and over and over again to every single one of these Fed hiking cycles. It marks the end and the start of a new economic, a new business cycle, a new cycle of interest rates. And a tale as old as time, the soft landing headlines peak, and in recent weeks, they've begun plummeting again as economic data is continuing to worsen on multiple fronts, and pundits are coming to realize soft landing, maybe it isn't a reality after all. It's going to stay a dream.
Yeah, that chart you made is hilarious. I'm definitely gonna have to share that one on the screen for all the listeners. I know what you think long term will happen to Bitcoin in the event of a recession, right? Because they're gonna just have to pump more liquidity in, and Bitcoin's that sponge. But in the short term, how do you think Bitcoin will fare in a recession? And also, sort of piggybacking on that, is like with the spot ETF. So let's say we go into a recession, but at the same time, a spot Bitcoin ETF gets approved. There's sort of one's a bearish force and one's a bullish force. So how do you think about that scenario potentially playing out over the next few months?
Right. So, a spot ETF being approved would be absolutely massive, right? It would open up the floodgates to these institutional flows that have, arguably, ostensibly, at least speculatively, wanted to buy Bitcoin and been waiting on the sidelines. I don't actually know the amount of institutions that have, but purportedly there have been plenty. And at the very least, it will open up the ability for institutions to allocate in the future. So billions, hundreds of billions, close to trillions, even more than trillions of dollars worth of capital on the sidelines now able to be deployed into Bitcoin. That's huge. And it's becoming more likely as the days go by. So that is a force that really can't be denied. Okay, let's be real. But by the same token, Bitcoin, like I said, is the most porous sponge for global liquidity. It's very beholden to what global liquidity is doing, what central bank balance sheets are doing. Are central banks expanding the money supply, or is the money supply contracting? And right now, at least by the M2 measure of dollar money supply, we're in the first period of money supply contraction since 1935. And I'll give you a guess as to what happened in 1935. It was the meat of the Great Depression, middle of the Great Depression. Now, I hate being somebody who uses those terms. It's the worst X since 2008. It's the first Y since 1929. But in this case, it is. And if you view Bitcoin as this porous sponge for global liquidity, and all of a sudden the sink turned off, actually the sink is sucking water back out of the sponge. I don't know how that would work, but envision a sink that could suck water out of a sponge. That's what's happening right now. So global liquidity is drying up. It's falling. It's deteriorating secularly, and it will get worse as places enter into recession and liquidity draws down even further. And until this huge risk on impulse that comes as a result of a wave of money creation globally happens, there really isn't an impetus for Bitcoin upside, even if an ETF were to be approved. Of course, there are several Bitcoin native factors that are at play, one of which includes, of course, a Bitcoin ETF. But in my view, in my eyes, the biggest single factor, and the data backs this up, is global liquidity. What is global liquidity doing? And if global liquidity is in contraction, Bitcoin, traded as a high beta risk asset, this sponge for global liquidity, is in contraction too. So that's even with the halving coming up, Bitcoin supply being cut in half, even with the spot ETF potentially on the horizon. I know the SEC is going to go to the very end of their deadlines. They're going to extend and extend and extend. It's on the horizon, could happen in the next 2-3 years. I don't view either of those factors as being able to offset the giant woolly mammoth reality that global liquidity is and always is in the driver's seat. So yeah, if that answers your question.
Yeah, that makes sense. What's going on with Binance? You've talked about this a little bit. Does Binance have to go under before an ETF gets approved? Because it seems their main concern is manipulation in the spot market from offshore exchanges. Basically, they're pointing the finger at Binance. And also when I think about, these shitcoin exchanges going under, right? Once FTX imploded, that was basically the floor, and it was up only from there. So do you think that's sort of the same situation with Binance? Do they have to collapse before we can get, a next Bitcoin bull run?
They don't have to collapse, but I think that it'd be good if they did. Not for the Bitcoin price, but for Bitcoin in the long run. Binance is a hotbed of fraud. I don't think I'm going to get sued for saying that. Hopefully not. I mean, Binance US isn't even an incorporated entity at this point. Let's be real. So many resignations. Even if they wanted to sue me, they wouldn't have jurisdiction because, again, Binance US is hardly a financial institution anymore. But backing up, it's kind of inarguable that Binance is this huge hotbed for fraud, not just with the stuff that they list, but with their practices behind the scenes, in the things that they do, the shady dealings they've been involved in. It would be better at the end of the day for this wash trading enterprise that is Binance, this wash trading, heavily fraudulent enterprise that is Binance, to go under. Binance services a great deal of Bitcoin's liquidity. If Binance goes, Bitcoin will get dragged down. Make it drag down into the 4 digits. Make it drag down into 3 digits. Something that's totally unimaginable. Think about it from this perspective, the pain trade. Right? What is the trade that we don't want to think about? What is the trade that we view as the least likely that will cause maximum amount of pain? The pain trade is Bitcoin going much lower than anybody could possibly imagine. That may happen if Binance goes under, okay? But in the long run, it's much better for Bitcoin because the buying will be happening at institutions that are not fraudulent. Just like the Fed refuses to face reality by kicking the can down the road and allowing rates to stay lower for longer instead of having a multi-decade period of austerity. Before Bitcoin gets bigger, I know it is in Bitcoin's best interest in the long run for fraud to be totally wiped out and not a major part of Bitcoin purchasing. So the sooner Binance can go, the better. And ultimately, that may cause extreme pain for Bitcoin, but we're staving off much more pain for Bitcoin if we allow Binance to continue to be an entity several years from now.
Do they have to go? Can they continue to survive and do sort of fraudulent activity offshore, right? If, Binance US basically doesn't exist at this point and Bitcoin is this permissionless network, is it possible that Binance just continues to exist into perpetuity?
Well, the thing is, Binance US and Binance, turns out they're not separate entities at all. Who would have thought? At least that's what the SEC is alleging. And that's been backed up on chain, several instances. And so if that's the case, all of a sudden, this tiny sister corporation, now the SEC and all relevant regulatory authorities, the full might and force of the United States government, the United States intelligence regulatory authorities, now they have jurisdiction over Binance proper. Because it turns out your business that was operating in the US was not a sister company after all. And it turns out it was a wolf in sheep's clothing. It's actually not a wolf in sheep's clothing. Wrong expression. But it turns out that it was the big company all along. It was your offshore exchange. Now, all of a sudden, the U.S. has jurisdiction over that. And so, I do imagine that if these allegations are true, which I believe they are, but if they're proven true in a court of law, I believe that the SEC and other regulatory authorities get jurisdiction over Binance and the ability to prosecute them. And I believe Binance dies swiftly after. And again, in my view, I believe that is the best case scenario for Bitcoin in the long run, right? If this hotbed of fraud, ultimately, again, it's our hubris and our, not greed necessarily, but our extreme hope that Bitcoin turns into a $1 million per coin. It turns into a $5 trillion, $10 trillion, $20 trillion asset in our lifetimes. Right. And so with that underlying belief, conscious or subconscious or not, like as human beings, we go, well, maybe I hope Binance can stick around. But the reality of the situation is like we need these guys to go right in the long run. If Bitcoin is to be as successful, if it's to ultimately trade as the asset that its properties allow it to be, then Binance has got to go. And the sooner the better. And I think, in the event, which I believe will happen, that Binance US is proven to just have been a part of Binance and not a separate entity at all, then I believe that downfall will come sooner rather than later.
Yeah, I agree. Once they're gone, it's going to be a lot more clearer, more blue skies for Bitcoin. So I got two more sort of more fun, lighthearted questions before we wrap up here. At the bottom of this doc I've shared with you, it's a meme you tweeted, and I want you to explain this meme because I find it hilarious and it ties in nicely with what you were talking about earlier.
Yeah, for sure. So this is essentially two central bankers eating cow shit. And this is an analogy for modern monetary theory and why it's such a, I was going to say a very bad word there, but we'll keep it PG-13, a terrible way, extremely inaccurate way of viewing the United States economy. So if you look here in the top left, this is Ben Bernanke and good guy, Paul Krugman, another wicked smart guy. So Ben Bernanke, chairman of the Fed through the 2008 financial crisis. Paul Krugman, extremely unintelligent Keynesian economist who recently said that if you take all of the relevant parts out of the CPI inflation bucket, then inflation didn't go up. What a brilliant insight. Anyway, so these are the two gentlemen in the cartoon. This is what they're saying. So Paul Krugman says, Bernanke, I'll pay you $20,000 to eat that pile of bullshit. Ben Bernanke says, deal. And then Ben Bernanke eats a bullshit. And then Ben Bernanke says, Krugman, tell you what, I'll pay you $20,000 to eat that pile of bullshit. And then Krugman says, sold. And they're both moseying down the street, both of them having eaten a pile of bullshit. And then in the final slide, Ben Bernanke says, I'm feeling pretty sick. We both ate shit, and neither of us are any richer. And then Paul Krugman, right, the great Keynesian economist he is, the great modern monetary theorist that he is, he says, you're missing the bigger picture. We've increased GDP by $40,000 and created 2 jobs. So that it's a cartoon that highlights the absurdity of Keynesian economics, the absurdity of modern monetary theory, and the notion that spending is equivalent to economic growth. It's equal to economic strength. Spending is not the greatest way. GDP is not the greatest way to measure economic strength. In this cartoon, in perhaps the most comedic and I think poignant way, and the easiest to understand way, illustrates exactly why Keynesian economics is a load of horseshit.
Yeah, that's spot on. That meme is hilarious. I love a good econ joke. My last question for you, you tweet a lot of memes, GIFs, videos from The Big Short. Certainly plenty of analogies to that period leading up to the great financial crisis as to the present day. So if you had to say, where in that movie are we right now? What scene would you put us at?
Yeah, of course, the bucket of risks very different now than it was in 2008. I'll certainly say that I'm guilty of doing too many analogies, but at the end of the day, we're on Twitter. I need to make it understandable for people. The bucket of risks is very different now than it was in 2008, just like the bucket of risks was different than it was in 2000, 1994, 1987, and every single period of economic downturn that we've had before that. I will say, though, that if we are mapping out cycles just based on up, down, up, down, up, down, and how close we are to either the peak or nearing the downfall, I'd say we are at the period now where they've gone to the trade show, they've gone to the realtor in Florida, they've gone to the guys who are bartenders, they've gone to the strippers, and now they're putting all of their money on the fact that this can't last. I think somewhere within that 30-minute chunk of time in the movie is potentially where we are. And to illustrate that in simpler terms, we are at the point where people are realizing that all of this hot air is being very, very slowly let out of the hot air balloon that is the U.S. economy. I'm not saying all of it's bad, right? But I'm saying that I'm just using analogies here. With real interest rates at the highest level they've been at in 15 years, I think many traders, at least the tide is starting to shift, and people are beginning to realize that the lagged effects of monetary policy are beginning to take hold. You take a look at job openings, you take a look at new hires, you take a look at wage price growth, you take a look at PMI surveys beginning to worsen, you take a look at consumer sentiment beginning to worsen, right? We're at the turning point. Right, the big guys have already begun to realize that something is amiss, and the lagged effects of monetary policy are beginning to hit the United States economy. So that's the point at which we are at in the movie, if I were to analogize it to that.
Appreciate it. Thank you for coming on, sharing your insights. Where can everybody find you, find the Bitcoin Layer, and learn more about what you're doing?
Of course, you can find me. The @ that you see on screen is the same @ that is to my Twitter. I don't know if I'm pointing to the wrong side of the screen here. Just @ Joe Consorti, first name, last name. You could follow me there for all of my insights. And also go to thebitcoinlayer.com, subscribe to our YouTube channel, and subscribe to our Substack, where I do long form writing and videos about all things Bitcoin through a global macro lens.